Hi, let's talk about hybrid funds. So what are hybrid funds? Hybrid funds are a combination of equity and debt. So it's ideal for the first time investors who are venturing out into equity funds because it's a combination. Debt fund would provide stability and equity fund can be volatile. So a combination of the two would give the much needed breathing space for a first time investor. So let's look at how the hybrid funds are structured. So the one is, so number one is the arbitrage funds. Now this is actually a combination of equity and debt. The percentage of equity is more. It's around 65% or more than 65%, and the rest is debt. Now, when is an equity fund called an equity fund? So it has equity plus debt. However, it will be called an equity fund in case if the equity investment is more than 65%. So in arbitrage fund, the equity investment is more than 65%. So it qualifies as an equity fund and it's taxed as an equity fund. So the taxation on equity fund is much lower. Now in arbitrage fund, what happens is, now what is an arbitrage? Arbitrage is, taking the price differentiation between the two markets. So a share can be trading in NSE and BSE, and if there is a price difference, you can actually take advantage of it, and that is what the arbitrage fund does. So it takes advantage of two different markets. Now this could be one cash market, the other could be a derivative market, and by doing this, you are in a way hedging the portfolio. So the equity investment, the risk of equity investment actually goes down, and the debt fund is also there, so the debt part is also there, so the risk, actually the overall risk of an arbitrage fund is much lower, and since the risk is much lower and the return as a result is lower as well. So let's take an example here of an arbitrage fund. So arbitrage fund is actually kind of an equity saving fund. So we look at this, this has given 6%, 6%, 7% kind of a return. However, in equity, if you're invested for more than 1 year, it's qualified as a long-term investment, and the tax outgo is really low. So we'll cover that in the later section of this course. So that is where it would make sense. Otherwise, the risk is comparable to a short-term debt fund, right? So that's the arbitrage fund for you. And the investment, if we look at the Kotak arbitrage fund, so it's a hybrid fund. This is the total number of assets, and it was launched in 2005 and has given a return of around 7.4%, right? So that's pretty good. There are others as well which follow the same model, and the return is almost comparable. Now the risk here would be lower, and so the return would also be lower, but the advantage is from a taxation point of view, right? Now the other hybrid funds are conservative hybrid fund, which is in which the debt portion is close to 70%, 30% would be equity portion. There is aggressive hybrid funds in which the equity portion would be 65%, 70%, and 30% would be in the debt fund. And then we have a balanced hybrid fund in which 50% debt, 50% equity. Since the equity part is less than 65, this would be considered as a debt fund and would be taxed accordingly, right? So these are the examples of or different types of equity funds that are available. We have covered what kind of what are the different types of funds that are available, and now we would get down to the time horizon, and then we'll get to the main stuff wherein we'll learn how to make a mutual fund portfolio that can actually build wealth, right? So let's dive into the time horizon bit.